Okay, guys, we're going to get started in about just a minute. Let me wrap around without getting in your guys' way. Charlie, let's get out of the room. All right, guys, so we're going to do Whiteboard Wednesday night. Really quick before we start, I've been getting a lot of DMs about people getting laid off, and I want to bring to obviously your guys' attention that, one, I feel for you, and I'm really sorry for that to happen. That's never something good you want to hear, obviously, with somebody that's delivering income for their family or bringing income, and something like that happens. It's horrible to hear, so I'm sorry for anybody that's reached out to me that's happened to you. Secondly, I want to be brutally honest, is I don't think that's going to stop. I think into late 2022 and early 2023, that would not be a good thing. And I think a lot of people are going to get, there's going to be more layoffs to come. That's not to scare or fearmonger. I think that's just the way the U.S. market's going right now. So any industry I've talked to, any person I've talked to about a job, I've heard either hour reduction, companies are cutting costs, job performance is being evaluated really closely, and it's not the economy the way it's going, especially with the Fed increasing rates again today, 75 basis points. I don't see this slowing down anytime soon. If anything, I think it gets worse before it gets better. I've had a lot of recession-proof webinars, so those have been, I've obviously talked about the ways to kind of be recession-proof, set your family up. My family personally went through something like that also a long time ago in 2008 when my dad lost his job and he was a sole income earner, so I know how it feels, obviously, and we lost everything. So with that being said, guys, I do want to obviously talk tonight about our Whiteboard Wednesday. But if anybody's having troubles, if there's any fear out there, please send me a DM and I'll help you in any way possible. Okay, so to shift gears into our 8 solid ETFs that can make you rich is what our Whiteboard Wednesday is about tonight. I want to kind of start the presentation and take a step back before jumping into the ETFs and specific investments. I want to kind of paint the picture of where these come into play from an investment standpoint, and what things to consider as you're making these decisions. Because when I talk about 8 solid ETFs, most people think like, hey, these are the 8 ETFs. Like I posted the other day on my page the 10 ETFs to consider. Okay, so you'll see some similar ones up here, and I got a lot of questions like, hey, should I just put let's say 10% in each one, and out of the 10, that's 100% in total? Absolutely not. That's an awful decision. Please don't do that, and that's not what I was trying to voice in that post by any means. I'm giving you guys options in education to make a good informed decision to make a really good strategic portfolio that works for you. This is not to say any of these up here are meant for you. I have a hard time believing the ones we talked about tonight couldn't apply to you in some sort of way, but they might not, so who knows. Very first thing, when we are talking about investing in ETFs in particular, let's take a step back and start up here. So where do you actually invest in ETFs? So there's layers to index or ETF investing that I talk about a lot. And we need to understand what part of the stage that these actually come into play are. So the first thing you need to do is select a broker or platform that you're operating on. So this could be a Vanguard, this could be a Fidelity, this could be a Charles Schwab, this could technically be like a Robinhood, this could be a TD Ameritrade, this could be a E-Trade, those big name broker names that you're working with. So you can't just go and go pick up stock at just on its own per se, technically speaking. You have to go through a broker and operate through a platform of some sort. And so this is a really important step. I'm not going to cover a lot of that today as far as what to look for, but high level is low fees, low cost obviously, not low cost products, but low fee products. Two different things. Cost and fees are different. Good customer service, reputable, and good investment options obviously is the main thing. So broker, Vanguard, Fidelity, Charles Schwab, they all work. Those are my things. I wouldn't work with an E-Trade or TD Ameritrade. That, hence the name, is trading. We are investors here. We don't trade. So I would stay away from this platform. You could invest there, but it's built for trading, not really necessarily investing. But once you select your broker, my preferred broker is Vanguard, which a lot of these are Vanguard funds, hence the V's in front of every single one. So Vanguard, I go with Vanguard, and then below that, I have to select the actual account. So I hear a lot of times people are like, hey, 401k, I'm investing in a 401k, but I also want to invest in the stock market. The 401k is just an account. The IRA, which some people refer to as a Roth, is just an account. The Roth is not, there's no such thing as a Roth account. It's a Roth, it's a type of account, but it's not an actual account. A Roth or IRA or a Roth 401k is the type of account. I have an entire Whiteboard Wednesday, guys, on Roth and 401ks and IRAs and stuff like that. It's one of my first ones, so just scroll back on my YouTube or scroll back on my Reels and you'll see that if you want to learn more about that. But let's say you select an IRA, a 401k, a brokerage, an HSA, or some sort of account like that, 403b, 457. There's so many different types of accounts. Now, once you select those accounts, now 401ks obviously are kind of like given to you through your employer, but you would have them through a broker. Like you, let's say you work at like Amazon, and they have Fidelity as their broker. I have no idea if that's true. And then their 401k is the account, so that's kind of already given to you. And therefore, in that situation, the fund that you select is kind of what we're talking about tonight. So the actual fund is the level of the investment that we're talking about tonight. So the ETF is the fund, or the index fund that I talk about a lot is the actual fund. So until you get through the broker and the account, we don't want to talk about any of this below. But now once we get to the fund, this becomes relevant. And this is really, really important to understand education behind funds and also kind of how to assess the funds, okay? And then so from this layer, what is an actual ETF? What is an actual index fund? So the actual fund itself, guys, is an investment product. So you're buying an investment product here. That investment product consists of usually companies within based on the asset class that you're buying. Let's just say stocks or bonds or whatever, an index fund or ETF. It's just a group. It's literally a collective group of stocks. So to put this simply, I wish I had a little better of a visual. I kind of took up too much space with all the funds and stuff up here, so I couldn't draw this visual. But think of it this way. Think of everybody in this IG Live tonight taking money and handing it over to me, and me saying, okay, I'm going to put it in this huge pot. Here's my pot right here. I'm going to collect all your money, and I'm going to put it in this pot, okay? And I'm going to go invest, and this is going to be our mutual fund. This is our fund right here. You guys gave me a bunch of money, and this is our fund or our ETF. Now, the way it's distributed is going to vary based on the product that you actually have. So let's start with mutual fund, and let's break into index fund, and let's break into ETF. So mutual fund, just like I said, a pot of mutually collected money per se, and then you give that to me as the fund manager, and I'm going to go invest your money into all these companies right here. And so these companies are going to be Amazon, Google, Meta, Facebook, or Netflix, Nvidia, all these different companies, right? Those are the companies that I decide to go invest in. So you as an investor need to understand my goal of this fund. You're giving me money, right? And on these internet gurus that are throwing out VU and VTI and VB and VUG. Unless you know where those things are being invested and the fund manager, technically speaking, behind it, it's not a good, wise decision just to invest because somebody says ticker three letters, symbols at you, and you say, oh, that's a good idea. You have to understand the core investment behind that or within that, okay? And what my motive as an investment fund manager is. In this situation we're referring to, I'm a mutual fund, an actively managed mutual fund. I don't like to be active. The example I talk about is a lot of index funds and ETFs, but I want to explain this point before I get to that point. So, as a mutual fund manager, myself, taking your money, I attacked, in the fund's interest of providing great returns or whatever my goal is, and that's going to be listed in what's called a prospectus or a fact sheet. Okay, so that's going to tell you all of the details and think about this. The prospectus is the book version, a summary or a book version of the fund itself that I have. Let's say VTI, VB, or VNQ. Then the summary. All you cheaters that used Spark Notes in college and high school, you know who I'm talking about. That is the fact sheet. So that's like the bullet point version. Like, hey, the teacher gave us an entire book to read. Screw that. The prospectus is a waste of my time. I want to go to get the fact sheet. I just want to get the bullet points and the basics to understand what these actually are. That is the fact sheet. That's typically what I, as an investor, will look at. And so I could pull up the prospectus. You'll get the annual prospectus every single year in the mail if you're an investor or a shareholder in these types of different funds. And that will tell you all the details. I throw that in the trash, to be honest. Actually, I have electronic delivery at this point. But so we have the fund prospectus and the fact sheet. So now I kind of get an idea as an investor exactly what I'm doing. And now I get to make informed decisions based on my criteria search of what kind of fund I want to invest in. Do I want to invest in an actively managed mutual fund? And that's a big no for me. Everyone has their own preference, but I do not like what I just explained. I don't like the active manager piling up your money and then going to actively pick and buy and sell all these different stocks. Because he's doing that or she's doing that, like there's capital gains distribution that goes back to the shareholder, and that impacts your portfolio and your returns directly. And you pay me a fat fee. So these fees are typically like 75 basis points, 0.75%, right? And so that gets really costly really quick. And my goal as an actively managed mutual fund is to beat the market. I want to beat the market entirely, okay? That's my goal. Now, let's go from mutual fund to index fund. An index fund is literally the same thing for the most part, right? Take your big fund of money. I'm going to throw it all in here. I'm going to collect all your money. And I'm going to do one push pretty much for the most part into the market. And that might be a specific S&P 500 type deal, the largest 500 US companies. I'm going to throw that money there and I'm going to take off, and I'm not going to charge you anything. I'm going to charge you like just a penny or a couple basis points, really small fees. Sometimes somewhere, Fidelity, I might not charge you at Fidelity, but I'm going to charge you at Vanguard, but it's going to be a really small, like let's say 4 basis points, really, really cheap, almost non-existent. Not really going to make much of an impact, $4 and $10,000 invested type deal. So I'm going to take that money, I'm going to invest it for you, and because you guys use my investment product, technically speaking, through a broker, which is Vanguard, I'm going to charge you something, and then you just kind of sit passively for years to come, and that's a buy and hold investor. That is the bread and butter, and that is the best thing about index funds, is I don't get charged hardly anything, but I still get access to all these amazing companies and amazing funds within. And so that's an index fund. The difference between index fund and ETF are very, very similar. They're very similar products, right? ETFs pretty much the same idea. So I don't break my back, I'm not going to pick that up again. But an ETF is pretty much the same thing as an index fund. The main difference of an ETF and an index fund is when it's traded. So an index fund, remember, the market opens at 9:30 and closes at 4 every single day, 4 p.m. Eastern Standard Time. So with an index fund, if I decide to, and these are all ETFs on the board, guys. These are exchange-traded funds. If I buy, let's say if I buy an index at 10:30 p.m. Eastern Standard Time, and I decide to buy VTSAX, my favorite index fund ever, right? That buy does not go into effect until market close. So if the market's doing like a roller coaster that day, and I buy at 10:30, I don't get that price right then. I get the price at the end of the close day. The ETF, on the other hand, will be at the spot of the buy, so at 10:30 p.m. Eastern Standard Time, or a.m. Eastern Standard Time. If I buy at 10:30 and I lock in that price, I get that price at that given time. So most people are like, "Oh my God, why would you not do an ETF? Because you get to choose the price." A few things. There's a few things here. So how do I want to break this down the best way possible? So first things first is it doesn't matter if you're a long-term investor and you automate all your investments. So if you automate every Tuesday, every 2 Fridays, you put the same dollar amount in one of these funds, the price at 10:30 versus 4 over a 30, 40-year period is going to be non-existent. It won't matter. The problem is you can't fully dollar cost average at this point in time with ETFs, at Vanguard specifically. Some brokers and some platforms, you're able to do that and buy at a fractional cost. You can automate ETFs at Vanguard, you can't actually buy it at a fractional cost. So what happens is if the Vanguard price of this fund right here is $100, and I put $100 every weekend, I buy 1 share, right? If this drops to $94, I buy 1 share, but $6 kind of sits in my money market account, and there's a little bit of a drag from a automation standpoint until I have enough to buy the next share. Because you have to buy a full share, so the price of $100 or whatever that may be, you have to buy the full share. On a fractional basis, it's different, right? So I've posted on this, I don't know who's followed and who hasn't, but I'm currently 100% indexed for the most part. I have some ETFs with my dollar, but indexed within all of my accounts. My broker's Vanguard, all of my accounts, and all my funds are index funds. I have talked about transitioning to ETFs, which is a non-taxable event if you go from like-kind ETF to like-kind index fund. And that's very important to understand. So VTI, which is my favorite, which is not investment advice, and I'm not saying go do this because it's my favorite, it makes sense for me. VTSAX would be the like-kind, the same exact product, but an index fund version of the ETF. If I take my index fund version and I swap it to this, it is a non-taxable event. I can do this in a retirement account because there's no capital gains when I sell, but in a non-retirement account, that could come into play. So if you're selling any product, an index fund or whatever, to swap into this, typically you would, like a separate one, right? It would be a taxable gain or loss. In this situation, if it's like-kind, it's the same. Okay? So with VTSAX, so my point is, when Vanguard allows fractional buys, which they are openly have told me on the phone that they are looking into and they will get close to doing this, I will switch 100% of my portfolio from index to ETF. There's a 0% change in my strategy. The only difference is there's a little more flexibility on the sell side. Not that I'm here to do that. And also, it's slightly cheaper. So technically speaking, like I said earlier, mutual funds, an index fund is a form of mutual fund, and therefore, when there's capital gains distributed, which there's hardly anything, because remember, they're very passive in nature, and there's not a lot of buying and selling going on, but there could be, and those could be distributed, so that's a minor cost, like really, really minor. There's also an expense ratio, which is the cost of owning the fund, that is slightly cheaper. We're talking guys, when I'm talking about this change, we're talking pennies, hundreds of dollars max, like nothing significant. We're talking 0.04% to 0.03% right here. So nothing crazy by any means. Don't like get overwhelmed by that or anything, or like think I'm like changing something crazy. It's really, for the most part, like the same thing. But I'm going to squeeze every piece of juice out of my investment portfolio as I can. And ETFs are more solid in my opinion if I were to pick one or the other, and if there's no taxable impact, I'm good with the decision. So that's a little high-level overview, guys, of kind of where we position ourselves today. The other thing is, if you are index fund investing, please do not buy a Vanguard index, these are ETFs, remember, a VTSAX on another platform like Fidelity. So if I go buy VTSAX and Fidelity, you're investing at Fidelity. I've had this happen countless times, so I'm saying this for a good reason. Is someone's like, oh my God, you're in VTSAX. I'm going to go invest in the same thing. And then they pay a $75 transaction fee at Fidelity for years to come. That's not my fault, one, because I've explained this a million times, but two, don't be that person. Like, first off, never just listen to somebody that says, invest in this, or I invest in this, therefore you should. That's really crap advice. So be careful there. But secondly, is if you're with Fidelity, instead of VTSAX, you need to find the equivalent fund at Fidelity, which is FZROX. You can go into my link in my bio. I have a free conversion tool for you guys, a conversion PDF that will show you exactly the conversion tools from Vanguard to Fidelity to Charles Schwab, which are the three biggest brokers. The equivalent funds at each broker. So if you're trying to link the two, guys, broker and funds, I have a free tool in my link in my bio for you guys to download. And you guys can see the funds we talk about tonight, how they're converted to other platforms if you're not with Vanguard in particular. If you are with ETFs, there's no transaction fee like there are with Index, so it's not as big of a deal. I would still try to stick with the broker funds that you're operating on, right? So Fidelity funds, Charles Schwab funds, Vanguard funds. That's just a good rule of thumb in practice. The other thing, on the top right-hand column, as you're thinking about the account, right? And I've done this investment breakdown on a Whiteboard Wednesday. I'm not going to get into too much detail because I've done this entire presentation. But as you select your broker, you're within your account, you're selecting your funds that should be in line with your risk profile, your goals, your style of investing per se. You need to think about these things on the far right. Typically, a good way to think about this is 1 to 5 index funds or ETFs within a given account or portfolio. Do not complicate this. Do not Don't make this like rocket science, guys. 1 to 5 index funds, ETFs, is plenty. And I'll explain why. It's because within each one of these are thousands of companies, literally thousands of companies. So why complicate? It's not diversifying. If you have individual holdings or individual stocks, yeah, sure, you might need thousands, but you get that with one ETF or one investment. So it's more so about sector or exposure into a specific area as you think about allocating your resources and your investments. Secondly, dividend reinvestment. A huge portion of your returns, the 10% everyone talks about, is dividend reinvestment, and dividends in particular. So when you get a dividend sent to you as being a shareholder of one of these funds, you need to reinvest back automatically into the fund. Vanguards of the world will automate this process for you. You probably don't even have to select it, but if you do go select an individual holding, you will have to decide where that's going. You have to manually change that. Typically, they'll have the box pre-checked, but it's something if you haven't checked that's happening, you want to check it because they could be mailing you a check, they could be putting this in your money market account for all the dividend checks you're getting or dividend payouts. Be careful there. Dividend reinvestment is critical for your long-term performance. Automatic everything. I always talk about automation. It was a big piece of me becoming a millionaire by 30. Automate every single piece of this. That's the reason I don't use ETFs in particular right now, because there's a little bit of cash drag with the money market and the fractional share thing. But I do index funds at this point in time. And with the indexes, guys, I'm able to automate this entire process. I don't spend an ounce of my time per month on my investments. It is the biggest waste of time to sit there and stare at the stock market. It's the biggest waste of time to think about what the stock market's doing on a daily basis, a weekly basis, what the Fed are doing, what some company, CEO decided to bang his secretary, whatever happens right out there. Crazy stuff happens. Elon Musk decides to pull a freaking toilet into Twitter headquarters and take over Twitter. I don't care about any of that stuff, honestly. Just automate your investments into good quality investments and you'll be totally fine over the long run, as long as you're well diversified, which again, refer to the other presentation for that. Don't ever sell. Don't panic sell. If you automate everything and you're doing all these things, do not panic sell. The worst thing in the world, guys, is to sell at the bottom or even try to time the market and sell at the top. You're not going to guess the market. You're not going to time the market. If that was possible, other people would be doing it, and people try it for years, and they will for years to come, and they're all going to lose, and the same story is going to replay over and over and over. Do not sell your investments, guys. It's not worth it. Continue to dollar cost average into index funds, ETFs during the downswing and during the upswing, and you'll get the better. You'll get a great return long term. Okay, the last thing I want to talk about before we actually break open some of these ETFs and kind of talk about these ETFs in particular is this little Morningstar equity box at the bottom. I tried to do it as good as possible. I don't know if you guys can see that well. But essentially what this is, guys, is breaking open equities in general. So equity style. The style of equity that you hold. Equity being another name for stock. So a stock is a piece of a company, correct? So it is literally, that's how broken down it is for you guys. So a equity style, a stock in a company, ownership in a company, has different styles in which that company is, right? Whatever type of company this is. Could this company be a fast-growing company? Could it be a long-term, a CVS, more of a safe value play type of deal? Or is this a meta? Is this going to the moon with the metaverse type deal, right? So you have value, you have growth, and you have blend. The equity style box, what this is trying to represent is basically the riskier type of investment, okay? And the risk goes down and the risk goes that way. There's 9 little boxes, okay? And so there's a little value, blend, growth. So obviously blend is a mix of value and growth. And then you have a large cap, mid cap, and small cap. The valuation on what's considered large cap is a $10 billion company, which is basically the outstanding shares that a company issues out to shareholders in total, times share price. That's how you get a valuation, okay? So large cap, 10 billion plus, mid cap, 2 billion to 10 billion, and small cap, it's really 250 to 2 billion, and anything lower than 250 is actually like micro cap. And there's a little bit of subcategories to these, but in general it's large, mid, small, okay? So if you look at this, it gets riskier the smaller you get, and it gets riskier technically the more growth you have. So the most risky investment per se from an equity style position is a small growth fund right here, or stock, right? So small growth, that would be the riskiest position. And so, like, when you think of the S&P 500, typically, right, that's a large blend. That has some value and that has some growth in it, right? So the S&P is right here when you look at it from a risk perspective, okay? Now, from a risk perspective and a volatility perspective, they don't always align necessarily like apples to it's not always as clear as that, right? Just because it's less risky up here, like a large value or whatever, doesn't mean it doesn't have volatility. Volatility and risk can be two different things in a sense, right? But this is a good little box to kind of have an idea as we talk through these, kind of where these would technically be falling in relation to risk level. Most prospectuses or fund fact sheets will have some sort of a risk level in relation to other funds, like a 1 through 5 or something like that. I wouldn't really rely on that too heavy, but it gives you a high level indication of kind of where that fund sits from a risk perspective. Okay, so let's get into the actual ETFs, guys. So I hope that kind of painted the picture to where we're talking now. So now we want to get into the ETFs in particular. So my first and favorite ETF I want to talk about is VTI. This is the Vanguard Total Stock Market U.S. Stock Market Fund. So this is literally the U.S. stock market. As simply as that. If you buy this, you buy America. And so if you're bullish on America, you should be bullish on VTI. Even with the downturn in the economy, even with uncertainty, America has always laid golden eggs, just like Warren Buffett says. And I don't see that stopping anytime soon, even with the Ray Dalios of the world that says that U.S. has come to an end. All this, doomsday type of stuff, it happens every time, especially around, these specific times when the market's down and people are, extremely fearful. But there's no reason to be fearful, obviously, guys. Watch the presentation in my link in my bio. If you're worried about that, if you have any fear in the market right now, I'm not going to get into that detail tonight. This is a 3 basis points for the expense ratio, super cheap. Almost nothing. Their top 5 holdings, guys, is Apple, Microsoft, Amazon, Meta, Google. And just for FYI, guys, this data is everything pre-2022. So Meta have obviously fallen out. Things might not be exactly the top 5 at this point in time. As of 12/31/2021, these are the numbers. So obviously the market's had a downturn, so these numbers are not in relation to 2022. Pre-2021 or 2022 or whatever is what these numbers represent. So a 10-year return that this has had is 12.35%. The best year it's had is 33.51%, and the worst year is negative 5.31%. A few things on this for context. This is important. As you listen to this presentation, please don't go, 12 is greater than 10, therefore this is a better index fund or ETF. Do not do that. That's a rookie mistake for a number of reasons. First off, the biggest number is not always the best number, and it doesn't always align with your portfolio, right? So your goal might not be to hit the moon because of the downside of that, what happens with that, okay? So if you're hitting the moon and mooning, as the little children say in today's TikTok world, you have a huge downside potential. And so if you aren't able to stomach that, that's happening now. And I think the 2020 investors that got newbies into the market are understanding that, wow, this actually isn't as easy as I thought it was. There's a lot to this. Like, it doesn't just go up. It does like all this crazy stuff. So do not ever compare this to that for that reason in particular, but also every one of these investment products have different inception dates. This might have started a different date than this, and this might have started a different date than that. And there's market cyclical cycle, or there's cyclical cycles in the market, okay? So if large cap growth stocks, for example, were, from 2020 to 2021, or 2019 to 2021, they had a phenomenal time. They had a phenomenal ride. So if I'm looking at like maybe a 3, just an overall year-to-date return or whatever, or something like that, and I see this fund started in 2019 per se, I'm not saying it did, but let's say it did, that might show a really elevated number that you would be like, oh, that's awesome. But the thing is, maybe that was 2019 and this started in 2011 or 1945, for example, right? Like, the numbers and inception dates are going to change drastically, so you're not always comparing apples to apples here, and you have to be well aware of that because there are fluctuations in the market, different sectors get hot, and so if you're comparing the tech sector over the last 5 years versus a different type of sector like consumer discretionary or something like that, you're not really comparing the right data comparables because it can really throw you off from an investment standpoint. So don't only just pay attention to these numbers, you have to understand the context behind which these numbers are derived from. But this is good data still to look at, for sure. But understand the quality of where you're investing, which sectors of the market you're investing in, which exposure, you're getting exposure to international, domestic, emerging, all those types of things. Specifically China, specifically US, number 2, I think that's all I wanted to say on that part. Number 2, guys, is VOO. VOO. This is one of my favorite ETFs. Again, I don't own either one of these. Remember, I have index funds at this point in time. But VOO is a phenomenal ETF. These are like the same thing. And so I had somebody today in the DM say, hey, I have VOO and VTI. That is pointless. Unless you're in different types of accounts and you have different options or whatever. But if at the end of the day, guys, there's like an 85% correlation between the two, 85 to 90% correlation. This is the S&P 500, and obviously within the U.S. market, the S&P 500 is in. So the top 5 stocks are the same top 5 here and here because that drives most of the U.S. market, like I said. So to have VTI and VOO don't really make a whole lot of sense. I would probably select between the two. At one point, I was S&P 500 100% early on, and I've transitioned to VTI or VTSAX because I like the collective market versus just the S&P 500. I like to add a little bit of small cap and mid cap into that. So when you look mid cap, remember small cap, and where the S&P is just the large. So I like to bring all of this in. I also like to bring value and growth in. So I have the whole market in total. I kind of have this whole box in a sense. Versus some people like, I'm going to point one out. I think I have another. VUG. VUG would be obviously specifically a growth fund, a growth right here, large cap growth. So it would fall over here into this box, right? And there's also, I think it's VOOV, I believe, VOOV, which is S&P 500, but it's only specifically value. And so you can pull out value, you can pull out growth based on your risk preference and your style that you want to invest. But that's why I like VTI because it's kind of like everything: small cap, mid cap, growth, value, etc. This is a really phenomenal fund, guys. This is S&P 500. You can't go wrong. These two guys are like staples of a portfolio. So I'm not saying investment advice by any means, but I'd say most people are going to have a portion of this or this is a pretty big staple, especially if you guys are young investors and stuff looking to invest. These two are huge staples of most portfolios. This is like a big portion of my portfolio, obviously with VTSAX. But all my subscribers will see exactly my buys and my positioning and how I set my portfolio. But this is like a key, which is why I put it at 1 and 2, obviously. But that's something to be aware of. And then the 10-year return is 12.7 versus 12.35. Remember, it's pretty similar. And invest 32.33 versus that 33, and -4 versus -5. Okay, so those are the numbers for VOO. But let's get into different types of instead of like the broad-based ones that I always talk about, let's kind of get into more specific ones, right? So there's a few, and this is not an exhaustive list, guys. This is honestly as many as I can fit on the board. I could go, find 30 more of these funds and show you guys into a lot of them, right? But 3 is small cap, VB fund, VB ticker symbol. So the $, guys, is just a way to abbreviate, or it's like a search symbol on Twitter, so people use that as like a thing. So it's like natural to me to do that. But VB, if you search VB, this is an ETF, small cap ETF, right? So this will fall down here into the small cap portion. They have the top 5 holdings: Charles River Labs, Avantor, Biotechne, I don't know if I'm saying these right technically, Polcorp, Diamondback Energy, right? So this is definitely a larger risk versus like one of these things from like a equity style box, like the risk level right here. Your 10-year return is 10.57. Your best is obviously a little higher at 37, but your downside is a little worse. And remember, these are year-to-date end numbers, so the volatility within could have swung way up or way down past these best and worst years. on all of these here. It doesn't necessarily mean that's the lowest it's gotten. It's just from an end of the year perspective, that's kind of where it ended. Small cap is a really solid portion, especially for small cap value in particular. I'm a pretty big fan of. I do have it naturally through the indexes, like I said, so I don't like try to pull out too much of this stuff often. But small cap value is a really, really good play for a long-term investor. It's actually beat the S&P 500, I think historically, slightly. So it's something to look into if you're a long-term investor, maybe a small portion. Again, you do get all of this stuff, guys, that's over here kind of for the most part within like a VTI type deal or like a total US stock market, total broad market fund. VUG, like we kind of talked about, I cherry picked this one earlier, was like a growth. Oh, this is 5 basis points for the expense ratio, guys, up there. And then VUG is growth in particular. So if you want to pull out growth from the market in particular, you want to get a little bit of exposure there. It's 4 basis points, really similar to my VTSAX position. As you can see, remember it's growth, so it's going to obviously have these same names: Apple, Microsoft, Amazon, Meta, Google. Your 10-year returns a little better because it's maybe value brought this down over the last 10 years because value wasn't as strong as growth over the last 10 years. Therefore, you're going to see a little bit stronger returns. But remember context, because now value is swinging the opposite way. The Berkshires of the world kind of moving up in the rankings now. So remember, context is key when you look at 10-year returns. Your best is 40%, which is phenomenal, and your worst, technically speaking, is 3%. But remember context, because this one looks really juicy. Like you might be like, oh my God, this is like the best thing in the world. But you have to realize context, and I guarantee over the next 10, it doesn't look the same. I think there'll be a total shift, right? I could be wrong, but my point is things swing and there's shifts, so you want to kind of collectively have the whole entire market. VNQ is real estate in particular, a little higher on the expense side, but still relatively low. 12 basis points. I feel like a weatherman. I don't know why I'm feel like a weatherman as I'm saying this, but 12 basis points, and with VNQ in particular, guys, 12 basis points is a little higher. I like to keep it on the lower side, but I think as long as you're under 20 basis points, I'm pretty comfortable with at the end of the day. QQQM of the worlds are 15 basis points. QQQ is 20 basis points. I would prefer M over QQQ, but as long as you're under 20 basis points, definitely 25, but preferably 20, and then ideally under 10. And really, ideally to 0, as minimal as you possibly can get. Vanguard Real Estate 2, Set 2, whatever how you pronounce that index. American Tower Corp, Prologis, Crown Castle, and Equinix. 10-year return 6.48%. Best is 40.38%, and then the worst is 5.9%, 5.95%. I love real estate. I love VNQ as part of the portfolio for sure. Something to be particular about, guys, with REITs in particular, okay? So if you have a VGSLX or something like that, a real estate investment trust, which I'm a big fan of, remember, they pay 90% of their profits have to go to shareholders in the form of basically a dividend, okay? So dividends are taxed differently than capital appreciation when you go to sell. So when you get a dividend in a retirement account, it doesn't have a taxable impact because that's the cool thing about retirement accounts, right? There's no taxable impact. When you're in a non-retirement account, like a brokerage account, things can get a little different. You might be paying your actual tax rate, right? So it's a non-qualified dividend is what it's considered from a real estate investment trust, which means, in short, is your capital gains tax rate, short-term capital gains tax rate, which is your tax rate. Let's say you're in 24% tax rate and you get a dividend in your brokerage account. That is a 24% decision from a tax savings perspective. You need to be aware of that. That's a huge, huge benefit. The same goes through for bonds as well, guys. So like BND over there is like bonds. Bonds will pay fixed income payments, and those are taxed at ordinary income rates. So if you have this in a taxable account versus a non-taxable account, you are going to make a massive tax decision on that, wherever you put it. Be aware of that. That's a huge tip. VYM, guys, is a high dividend yield fund. I love VYM. Obviously, I put them up here because they're all solid funds for somebody out there. But JP Morgan, Johnson & Johnson, Home Depot, P&G, Bank of America, as you realize, some of these names have shifted. So, for example, look at these. A growth fund has a lot of high-powered big companies that are growing, kind of more in the earlier stages per se, versus a dividend fund that are more value-based in a sense, right? They have consistent profits. They're consistently increasing their dividend for 25, 50 years. They're in the King's list or they're in the Aristocrats list. And they have JP Morgan, Johnson & Johnson, Home Depot, some quality household names you guys probably use every single day. And they've been around forever and they've dominated and cornered their market. And so that's why you're starting to see a shift in the names from, Apple is obviously these first three to these. And if you look back at here, smaller names that you may have not even heard of because they're smaller cap, they're smaller value down here. So you got to realize the style that you're buying, the companies within are going to shift on this risk level and also kind of where they fall in relation to the whole market. So you go over there to the top right, you see VT, which is the total entire world at 7 basis points. Beautiful fund. So instead of owning just, and you know what guys, I really am mad at VXUS. I'm just going to throw it up here. I'm not going to really talk about it too much, but the VXUS is a phenomenal fund. This is an international fund in particular. But basically the reason I'm going to bring this in is because VT is basically VTI plus VXUS to an extent. And that's really what it is. And this is really how let's do VWO as well. So I kind of have a mix of VTI, VXUS, and VWO in a sense. In my personal portfolio, obviously to my personal allocations, for my personal goals, for my personal reasons that fit my risk profile and all that kind of stuff and align with everything I believe in and educated on. This is not investment advice. I'm not saying go do that. That's what I personally do based on everything. Okay, so VT is basically an accumulation of these two in a nutshell. This has about 1/4 of VWO already, which is emerging. So if you do pull like an emerging into your portfolio, you're basically upping your allocation to emerging. You need to do a weighted average as far as like how you're pulling out total allocations. Because if I go by 70%, 20%, and the difference would be 10, that's not necessarily a 70, 20, 10. Really, depending on the dollar amount, let's say it's, I wish I had Excel on me, honestly, but let's just say I had like $70 here, $20 here, and $10 here from a percentage standpoint as well, right? And I had 25% of 1/4 of 20 would be 5%. So 5% is really down here. So that's really emerging portion of international, and then this would be 15%. This would be 20 minus 5. So my real allocation here would be total US is 70. International, excluding emerging markets, would be 15, and emerging in particular would be 15. But this is my real allocation, but you have to realize 70, 20, 10 is what I have selected on my investments. So that is really important as you have a dollar amount in there, and you have to do weighted averages to come to your desired allocations. Most people don't know that, but remember, index funds are a basket. Remember, I'm not going to break my back again, but a basket of companies, okay? So if you buy VTI and VU, well, guess what? You have the same top 5 holdings and likely most of the same holdings. If I go buy VTI and VUG, okay, I've heavy weighted growth. So like I did with my emerging, I heavyweight growth, but my total allocations are not what I actually line my investments up to because there's a portion of growth in VTI. So pull out the growth portion of VTI to get your desired allocations. VU, for example, okay, so let's get into, I don't have VGT on the board. Let's say tech ETF, right? VU is 25% tech. So if I couple VU with VGT, and VGT is obviously, let's just say I have a 90-10 split between VU, 90%, 10% VGT, my tech allocation to this is massive. It would be 90% times 25%, right? Because you have to pull out and extract the tech portion of this index fund. So when we're talking allocations, you got to realize you got to take this out and do weighted averages of things if you're going to collectively have a bunch. Which again goes back to my top point, why you keep it simple with 1 to 5 index. And you don't overcomplicate this and just add like 3 million in ETFs or all 10 I posted, like I got the question a lot of times yesterday. If you do that and you somebody asked me the other day, can I do 10% at all 10 index funds? Absolutely not. That's an awful decision. Because 10% in every single index fund would be total overlap, and it would not make any sense to bring 10% down to here, but it just doesn't make sense. So anyways, total world over here, guys, is same top dogs. Obviously, Tesla made that list. 10-year return 8.2%, best is 26, worst is 9.6. And then you have BND, which is a bond fund, 3 basis points. Federal National Mortgage Association, U.S. Treasury notes, and U.S. Treasury bonds are a portion of the top 3 there. 10-year return is 0.72%. Bonds have had their worst year in history this year in 2022, FYI. That's not reflected in those numbers. And then best is 8.71, worst is negative 2.14%. And guys, that's a wrap of 8 solid ETFs that you could incorporate into your portfolio. The mixing of these, it needs a professional opinion. Do not just go blindly try to do this on your own. I saw, and I want to be respectful when I say this, somebody come to me today and give me their portfolio, and they were so overlapped, and it was such a poor portfolio at the end of the day that it's going to crush them in the long term. And I say that with respect. I'm not trying to call anybody out or bash anybody, but they DIY'd it. And when you DIY things, you get DIY results. If you're good at something, that's great. You spent time or whatever. If you're an expert, that's even greater. You're an expert and you don't have to spend as much time. But if you don't know this stuff, guys, one, I have a bunch of education and I constantly am trying to educate YouTube, post, Twitter, etc. But the bigger thing is just meet with a professional. And be smart when you do that. Do not pay like an AUM fee to do this, or with an advisor. Maybe you need some guidance or advice fee type of deal, or a one-time fee type of deal to kind of come to a desired allocation, pay for the education, understand this, and then start to kind of build upon this. One thing I did not mention, guys, is if you are a beginner and you have no idea where to begin, your safest bet is probably a target date fund. I hate to say that because I hate target date funds, but if I'm being honest, guys, to protect yourself before you go off into different types of sectors of the market like we're talking about tonight, it's probably wise to get kind of like a total fund in general, or a target date fund that's going to bring literally all of this stuff in. It's kind of one big melting pot. And you're going to pay a little more for it, and it's going to probably be a little less risky than most people would like. I don't know, it depends on your risk level. And I'm not a huge fan of it again, but it might make sense if you are beginning and you want to protect yourself as you're educating yourself. Remember, time is important when you make these decisions. The people that wait to Google things, guys, for 1, 3, 5 years, they lose out for the first 3 years. They realign, they learn something new from Google and other gurus on the internet. And year 3, and then by year 5, they're like, I give up, I'm going to go to a professional. You just lost 5 years of your decisions, 5 years of compounded interest, and 5 years that will set you back so far. The cost of waiting is expensive. Do not wait on this stuff, guys. It is so important to have it now, as fast as possible, in the right allocation that suits your needs, because you will waste 6 figures by deciding to not pay the professional and going elsewhere for your own DIY knowledge just to put yourself back a long time. So don't be that person. Just pay to play and just get into the game, learn as you go, and feel comfortable to get to a point where you are. I've been doing this, guys, for 10 plus years at this point in time. Education in the stock market, I want to say it's about 13 to be honest. So it's not like I just showed up and just knew all this stuff today. Still, from a professional perspective, guys, this is really basic, if I'm being honest. So like, if this is not complex, it's not. It might seem complex, I'm trying to break it down simply, but it can get a lot more complex than this is what I'm trying to say. So if you are going to, if you feel a little overwhelmed, there's no problem with that. It's normal, it's a normal feeling. But just realize I made it a simple concept in the financial world a lot simpler. I could go a lot deeper, and if people aren't prepared and understand and educate themselves, they can get really crushed by not knowing this stuff, guys. So with that being said, I'm going to flip the camera around, I'm going to answer questions, guys, and we will go from there. Alright, so I'm going to flip this around and get my chair out. I got to flip. Nope. Wrong way. Okay. All right, guys. I hope that was a good presentation in general for just an overall breakdown. I really hope it was. But I'm going to start going through all the questions. I'm going to start at the top, just to be respectful and try to answer as many things as I possibly can. There's a lot of people that came in, so let's see what we got here. working on my plan while I'm watching. That's awesome. One of my Budget Dog Academy students, guys, is working on her plan right now. That's awesome. Shout out to the Academy, guys. The Academy is next level. The Academy, guys, is just next. It's really next level. I mean, come on, let's stop playing. $43,000 from one of my students that just saved an extra $43,000 per year. Absolutely insanity. But we get results like that every single day. All right, let's see what we got. So I'm gonna scroll. Have Fidelity as a brokerage with FCRX is my biggest investment. Would you recommend FNILX or FXAX as a second investment? Definitely covered that one today with VU and VTI, the same concept there. All right, happy hump day. What's up, Lawrence? VTI is life. Yeah, VTI, guys, is solid. I'm a big fan of VTI, obviously. Fidelity only allows small cap, large cap, index, and things like that. How do I get my funds into these Vanguard funds? That's not true. Guys, Vanguard and Fidelity are very similar. So I like Vanguard a little better personally, but I'm also a little biased because I started there. But Fidelity offers the same stuff. Again, I have a free checklist or conversion tool in my bio. Amazon is Fidelity. Okay, I guessed on that, but I figured they were one of the bigger ones. Usually if you have a big, I got a really good text. I want to read it, but I don't want to pause this. Somebody just thanked me really big from the Academy. Anyways, what's the best way to compound interest? Do everything I talked about. Imagine being married to this dude. Appreciate you, Conroy. I'll have my wife say something to that. What about Fidelity funds? I love Fidelity funds. Fidelity is great. Let's see. Man, a lot of people came in. Is this all explained in your investing book? Yeah, guys, all this stuff is broken down in my investing book. There's pictures. There's a tremendous amount of knowledge in my Investing 101 book. So you can definitely go and get that in my link in my bio for sure. Damn, this is amazing info. You know, it's funny. There's like two sides of it, guys. There's always the trolls that come in, and then there's like total swings of extremity in here. But I appreciate it, Dasa. I appreciate that big time. I try to do this, guys, every single Wednesday at 8 p.m. Eastern Standard Time. Whiteboard Wednesday. I break down your topics that you would like me to break down. I don't just choose these. So send me in if you guys have ideas or comments of what you guys want me to talk about and teach on and present. I will spend my time to put this together, a very valuable presentation that will help you guys in the best way possible. Every single Wednesday, 8 p.m. Eastern Standard Time. If you guys want to put have ideas, go and comment below exactly what you want me to talk about, and I will do that. I have a bunch of Whiteboard Wednesdays saved on my YouTubes, on my Reels and stuff. You can go back and look at that as well. Do you have a link for transferring from one platform to another? I don't. I have, if you transfer old 401ks, I do though, in my link in my bio, but I don't have actual, I don't have that. What about VXUS or VWO? Two different portions, total international or a piece of international emerging. All right, let's keep going through this. What's up, Tiffany? What's up, Heba? All my Academy members, guys, show love and support in these lives. All right, I'm still scrolling, guys. All right, would you say ETFs are better than or a good complement to holding a position directly with stocks in the ETF? Yes. So in fact, I would do it the reverse order. So I would. Your complementary would be the individual holding. Your bulk of your portfolio would be the ETF for sure. So I would have it reverse. You should not be like the average person, guys, should not be 100% stocks. Like honestly, like they just shouldn't. And many people would say that and back that support. Even Warren Buffett. I like VTI more and FX, AIX. Yes, solid funds, guys. Solid funds. What's the oh, good question. We didn't cover this tonight. So what's the lowest minimum initial investment to start any of these? So good question. So the index or the ETFs on the board, guys, are just the share price of whatever those shares are. You have to buy a full share at Vanguard, so it has to be the full share of that. So VTI, I don't know, hovering around $100 maybe. VT Sachs, the index funds have a $3,000 minimum investment. But the difference is once you get a share, a $3,000 minimum investment, you then have, you can buy fractionally with the ETF, with the index funds, which is why I do that. So I could buy $1 every single week if I wanted. The ETFs, I have to buy the full share price every single time I buy a share. But like I said, once they transfer from full shares to fractional, I'll switch at that point. Because I really don't see a benefit of index over ETF, if I'm being honest, once they make that adjustment. But until then, I'm just going to stay put. Do I save my IG Lives? Yeah, guys, these are all saved every Wednesday, 8 p.m. Eastern Standard Time. This is not a standard live, guys. This is Whiteboard Wednesday in particular. So we do this every single Wednesday, 8 p.m. Eastern Standard Time. VTI is definitely my favorite. Yeah, it's hard to go against VTI, I guess. What is up, Xavier? Do I have a list of Fidelity ETFs to compare to VU? Yeah, so Fidelity's would be FXAIX, I think is the index for Fidelity. But I have it, guys, I have the conversion tool in my link in my bio. Can you post a screenshot of that board? You can watch the replay. Thoughts on federal market today? So open market committee, 75 basis points, pretty expected. I think the market, I don't know how the market actually, I think it ended up acting irrational as usual, but I could be wrong. I don't read too much into that. I kind of expected that. So I think everyone did. I might've been priced into the market. Who knows? Everyone seems to hate VU, but I prefer it compared to VTI. I feel like I'm getting the best of the best with VU. That's a good way to look at it, strive to be great. So I think VU is top 500 companies. The cool thing about index and ETF, guys, is there's competition within, right? So the top 500 don't remain the top 500. There's constant innovation and there's constant competition. So that's one of the cool things about the markets. Obviously, there's swings and downturns and volatility, but at the end of the day, you also have competition. Will Vanguard initiate automatic ETFs buy soon? They told me they were working on it. I called them in particular, but I haven't heard anything from it. ETF, what's ETF mean? Exchange traded fund. It's basically an index fund in a stock, had a baby, in a sense. So question, put in the question section, but you answered one already. Thanks. Oh, awesome, Remus. Almost 100 shares of VTSAX in my 401k. Awesome. That's really good news, guys. Anytime you have 100 shares or something, that's awesome. You're so helpful. Thank you. I appreciate the kind words. As always, guys, thank you so much. Is 100% the S&P good long term? I would say no. Here's why. So I think a S&P 500 fund is great when you're young. I think an S&P 500 100% is probably fine for 20s and 30s and stuff like that for sure. The problem becomes when you're starting to do to the withdrawal date. So there's a few things, guys. There's the growth stage of your portfolio where you're throwing money in and you're taking a lot of risk and you're not going to pull it for a long period of time. And it's not that big of a deal to have massive volatility as your dollar cost averaging in. But the problem becomes in the preservation stage when you're trying to secure the bag a little more and you don't want the volatility that comes with that risk and you're trying to bring down your risk level and you're trying to withdraw that money as well. Being 100% S&P could crush you. So if you're at 60 years old about to retire and you're like, all right, let's go. I have the S&P 500 100%. And all of a sudden we hit a recession at 60 years old, you're probably not going to retire because your value could drop 40, 30, 40, 50%. So you want to be careful and that's why allocation is really important to kind of bring down that risk level for you and kind of even out your portfolio. Again, it's kind of like Ray Dalio's method with the all-weather. It's his goal is not to beat the market, but on the volatility side, his goal is to beat the volatility of the S&P. So he's not going to lose all that money that the S&P would lose, but he won't beat the S&P, and he knows that. But he wants to keep the standard deviation a little closer. Can you add Canadian equivalents of Vanguard ETFs to your bio? I can answer that question. I don't fully remember though. Off the top of my head, I think VUSA might be one. I forget the exact tickers for Canada. I'd be able to look it up though pretty quickly. I'm a beginner. Brokers have the option of a package for beginners. I think 5 different stocks. What's your thoughts on that? So what they do, guys, is do a target date fund or they select your risk style and then they go select for you. Again, I think as a beginner, it's probably a pretty safe play. I wouldn't do that. I think it's suboptimal performance that you could be getting elsewhere. But again, early on, educate yourself, feel comfortable, and then at some point in time, you can kind of deviate from the the broker's recommendations, which I in fact think you should. But again, guys, time is money. So if you're waiting on these decisions to make these for 3-5 years, just pay a professional and hurry up and get this money right, because if you wait on this stuff, the cost of waiting is expensive. I'll break down a stat for you. So if you want to be a millionaire at 60, just pure investment millionaire, right? Just invest in capital. If you start at 20 and you invest every single month, you only have to invest $290 per month. If you wait till 30, it becomes $670 per month. If you wait till 40, it becomes $1,700 per month. And if you wait till 50, it becomes $5,500 a month. Basically, if you wait, it becomes harder and harder and harder to catch up. So that's why I'm so adamant of my 22-year-old brother who just turned 23 today and 20-year-old brother. They're starting, one works at Fidelity actually, and one's in college. And I'm like, guys, start your Roth IRA. Get started now. I don't care what you think about what I'm saying. I promise you, you have earned income from a job. Put your money in an IRA and learn about it as you go, and just trust me as your big brother that I'm putting you in the best position possible. And so that's what I always say to my students and my clients, guys. Do not wait on this stuff, because if you paid a professional a consulting fee of $1,000, you might look at that as like really expensive. But I guarantee if you don't use that professional knowledge with $1,000 that gets you to your desired allocation, and you go DIY it, you're gonna lose 6 figures. If you could potentially up to 6 figures easily, if you mess this up. And I've seen it happen. You're in ARCs, you're in the ARCs of the world, because everyone on social media pushes ARC, which is I actively manage ETF. Like, it's not my thing. So the average investor, guys, and the ARC investor got crushed. But the thing is, that was what was popular. That was what was pushed on the internet. And if you're a newbie and you don't know that, you're going to fall for those tricks. And so the average ARC investor greatly underperformed, because not only is ARC well below the market, 60% year to date down, but the problem is when they got in. So the ETF the inception date was 2015, and there was nobody talking about it. And all of a sudden it got really popular in 2019. And all of a sudden everyone piled in at the very top, and it had a little bit ride up, and then all of a sudden whoosh, crashed. And it's unfortunate, but it happens all the time. And so those individuals are so far behind the 8 ball because they didn't pay a professional, they didn't get set up early, and they're going to pay for it. So I tell my brothers this all the time, guys. Like, obviously I will help them, so I'm not going to charge my brothers, but I say, guys, come to me if you have any questions. Obviously follow my content as best as possible, because I don't want you guys in a bad position of waiting too long or being the wrong things, or trying to go on Reddit and get like GameStop tips or whatever, or AMC tips, which are crap investments, or Dogecoin and all those kind of things, guys. Those are gambles. Those aren't investments. What stock is similar to VTI, to Fidelity? Again, guys, I'm going to say this one more time. I have a whole conversion tool in my link in my bio. FZROX is the answer. Turn on the World Series. I'm not watching the World Series. My Indians are not in the World Series. What's a good couples budgeting tool that is simple? Link in my bio. I have a free one. I also have a full course on budgeting if you guys want that too. So what would you do once you get to your 40s and 50s if you're almost VU or VTI? Add bonds slowly. You could add real estate to the mix. You could add commodities to the mix. You could add bonds to the mix. Different types of ETFs and index funds in particular, more safer, I guess you could say, plays, or less volatile ones. It just depends what your goals are. But yeah, guys, I have my book will explain kind of like the different asset classes, which are the 5 I just mentioned, and cash being the other one. But again, it's pretty simple as far as like the 5 asset classes, but then like it breaks open a lot again, like I said. So what if you want to be a millionaire at 60, but you're 55? Oops, didn't learn about investing until pandemic lockdown. You think there's hope? 100%. It's going to be harder. There's no doubt about it, guys. I'm not going to sugarcoat anything. If you're 55 and you just figure this out, it's going to be way harder than somebody that's 25. At the same time, I don't want to discourage you, because there is a lot of potential that you could have if you do it right this second. Like after this live, go figure this out. So don't waste your time, because at 55, it's going to be really hard to obviously catch up to begin with. But maybe it's not about catching up to the 25-year-old. It's suiting your needs, whatever those are. Budget dog, more like the budget goat. Appreciate you, Vincent. Let's see. How do you select a good fiduciary pro? I'm just going to go on the record and say I think fiduciary is kind of a BS term, and here's why. So fiduciary is that they act in the best interest of the investor or their client, okay? So I think there is that's very loose. I mean, I think there's a lot of ways you can claim that you're acting in the best interest of your client and also not, essentially. So sure, would I select a fiduciary over a non-fiduciary? Probably. But I would also just use good judgment, word of mouth, just due diligence, like confidence in somebody. Like if you can tell somebody's trustworthy or you feel confident in their ability or they've helped another friend or family in the past, like just probably roll with those people. Do your research and due diligence, of course. But I talked about this last night, guys. And that's a valid question. That's a really good question. I have a YouTube video on how to what questions to ask and stuff as well. If you are living in a fear state to work with somebody, right? Because I often see this as I want to work with somebody, but I'm so fearful of everything. I said this last night is you got to trust your gut and you got to trust, I guess the best way to put it is you really got to trust trusting yourself. That's the best way to put it, I guess. So I really think it's really important to have a plan, obviously, adapt to that plan, and go with your gut and do your due diligence. If you are online, and it might be me, because obviously most of you guys probably know me, but I'm sure there's new people in this live that have never met me, don't know my story, and all that kind of stuff. And they're like, who is this guy talking? Go to my LinkedIn. Go see who I've helped. Go watch customer reviews. Go watch testimonials. Do a lot of due diligence before you actually would reach out to me or another professional. Because if you don't, you're not going to trust that individual in anything. You're always going to be a little skeptical, and that's not going to be a good working relationship. You have to really, really trust the individual you're working with. And so on my Budget Dog Academy calls, if somebody comes onto that call and is they'll go through the process of asking me questions and stuff. And then at the very end, I'll be like, okay, you ready to join or whatever? We'll talk about that. And they'll say well, hold on. What's your background? And I'm done right there. I will kick them off that call, all due respect. And the reason being, before you got to that call, you should have done your due diligence. This is not me selling myself. I know what I'm capable of. I know my strengths. I know my weaknesses. I will openly say those. And I get results for my students. I'm not there to prove myself to anybody. And I will never prove myself. And if any other financial professional is sitting there, I'm the best. I do all the right stuff. You're probably dealing with a fraud. Why do they need to sell themselves? There's not one time in the world I have ever tried to prove my worth. If you don't want to work with me, you don't have to work with me. But the students that will work with me will get good results because you obviously can watch countless reviews of that. But at the end of the day, be very careful. Use your common sense. Use your judgment. Not everybody has the best judgment per se on others, but I feel like you probably know in 5 seconds if somebody's a phony or not. I don't know. It's pretty easy to tell, I feel like. So use that, but also, due diligence, confidence, and eventually you got to take that leap of faith. You got to take that swing and just, do it. And the thing is, if you sit there and you're idle and you worry all the time, you're not going to get far in life anyway. So you got to take that leap of faith. Just take the swing. If you miss, you miss and you learn. And you can switch out your investments eventually. If this investor pro or whatever sucks, so that's kind of my take on that. My T Rowe price is charging expense ratio of 75 basis points. Should I switch out to Vanguard? Yeah, T Rowe, that's a little too high for me. Did you and your wife have a separate brokerage account? We have one joint brokerage account. What bonds do I recommend? I don't recommend anything, guys. I just educate. I won't ever recommend anything. Pen Cap Chew too. I appreciate you buying the badge, guys. A lot of people have been buying badges lately. I do appreciate it for real, but I don't expect it by any means. So please don't waste your money on a badge. Go buy a coffee or something instead, or go help your kids with something. Don't buy me badges, but I do appreciate it. Let's see. Okay, looks like I have most of the questions answered. There might be one more. How much investment amount, this is a good question. So kind of to elaborate on that last one, how much investment amount would make sense to hire a professional like myself for investment guidance? So I'll answer this question in a totality, like the industry in general, right? So there's a few fee models. The AUM model, run as far as possible. The AUM model, I think, is a BS outdated model that shouldn't be around. I see the validity of it. I'm not really saying it shouldn't be around, but I think you can go elsewhere. Fee-based advisors, I think, are the best. So basically, if you're paying an advisor a one-time fee for financial advice of some sort, AUM is an asset under management. So let's say I decide to work with an investment professional. I don't do this one time. I give them my investments. They take over my investments and run with my investments, and I will pay them an AUM fee. That AUM fee will be expensive, and they will say, "Oh, it's free. Come on in. Here's your free coffee. Sit down. I'm going to impress you in my suit today, and I'm going to let you meet my boss, and we're going to, make good friends in the office, and I'm going to kind of jazz you up, and then I'm going to say, hey, I only want to take 1%. You got 99% of the rest." And you're like, wow, this sounds like a great deal. A professional 1%. I feel confident in the office, talking to these professionals. Well, 1% is really expensive. And 1% is pretty standard as well. So one is that's not the only fee. Remember, you have expense ratios. And a lot of times advisors, most advisors, I'd say, are trying to beat the market in some sort, or they're really aligning with your goals, to be honest. But a lot of them try to beat the market, especially for young people. They will lose because that's what happens. And they will also have actively managed mutual funds to try to beat the market. Those will have higher expense ratios. You will lose to the market based on their performance. You will pay an extra fee to them, and you will pay an extra expense ratio that's higher than what we talked about on the board. If they aren't doing that and they're trying to do what we talk about on the board, why do you need them, right? There's a few reasons, and emotional stability is a huge piece. Other financial planning needs is a huge piece. So it might not just be managing investments. It might be budgeting advice. It might be other things. There's a whole host of ideas and value that they can bring. And there's a lot of value they can bring, like a advisor, but be careful. Be very, very careful what you pay them and what the small percentage you give to them. Because I see it all the time. People think they got one up on an advisor because they paid 1%, and they realize, $500 a month for 30 years, $180,000 in contribution at 7% return, and you will be paying at 1% fee about $98,000, 2% fee about $180,000 over a 30-year period, and that's only at $500 a month. That's only at 7% returns, and that will likely be way higher, and the percentages could be higher as well. So you might have a 2.5% fee or whatever. That gets really expensive really fast. High net worth individuals could spend 7 figures in fees essentially down the road. Could it be worth it? Sure. If you are emotional, reckless, and you sell your investments and have no idea what you're doing, yeah, it might be worth to pay the 1% fee, because if you panic sell in this down market and you lose 30% or whatever it may be, I'd pay the 1% to have somebody from me walking off the ledge. But at the same time, I'd be very careful. Use your due diligence, be smart, use common sense and all that kind of stuff. How much you're going to pay them? Like I said, the 1%, which will equate to a huge number. Advice only or fee-based advisors, it's going to depend on the specific service that you're asking them to have. That could be $500, that could be $5,000. It just kind of depends what level of service they're giving you in return for your dollars. Every time, I never look at cost. I do look at cost, but I look at value. So if somebody charges me $5,000, but they provide me $100,000 in value, that's a really good buy. If someone charges me $5,000 and they provide me $4,000 in value, that's a really bad buy. And so it's no different than anything else out there. With that being said, guys, it looks like most of the questions. I'm exhausted. And that wraps up Whiteboard Wednesday this week. If you guys want me to talk about specific topics, of course, send me in DMs exactly what you want to talk about. I am looking for about 2 individuals in particular that are looking to take their finances to the next level, but you have to send me a DM, and that's a way to filter out people that aren't serious. So send me a DM after this, and I have 2 spots open that I want to talk to here soon over the next week or so. All right, guys, have a good night, and reach out if you have questions.